and let's get started on long-term financial planning. We do financial planning to avoid stumbling into the future backwards, and we want to look at the relationship and the interrelationship between investment and growth. Several key formulas you need to know. Getting started first, dividend payout ratio. What exactly is that? It's cash dividends paid out divided by net income. The other side of that would be the retention ratio. How much are you going to keep? So whatever portion of your net income that you don't give away, you certainly keep. This is called a retention ratio or plowback. So this would be additions to retained earnings simply divided by net income. You might call that B. Retention ratio is commonly known as B, and that's equal to 1 minus D. If we call dividend payout ratio D, B equals 1 minus D, and D equals 1 minus B. Capital intensity ratio is the inverse of the asset turnover ratio, total asset turnover ratio that we learned in session 3. And this is how many dollars of assets are needed to produce $1 of sales. So it's the inverse of capital inverse of total asset turnover, which tells you how many dollars of sales are generated per dollar of assets. Two key growth rates that we're going to want to know and remember from this chapter are the internal growth rate and the sustainable growth rate. Internal growth rate is simply the rate at which I can grow my company without any external financing of any sort. And sustainable growth rate is the rate at which I can grow my company's sales or sales revenue without any equity financing while maintaining a constant debt to equity ratio. We'll go over those in a little bit more detail here in a minute. In this chapter, we have 5 key learning objectives, first of which is financial planning. And what is it? What exactly is it? You'll find that in your career, you'll do financial planning just about everywhere you go. Very often, companies do a 5-year financial plan. Some have shrunk that down to 3 years because they just can't see that far out into the future. But nevertheless, you may do a 1-year financial plan, a budget. You may do a 3-year financial plan, which begins to become a little strategic, and certainly a lot of companies do 5-year strategic plans still. This would include all of the key financial statements: income statement, balance sheet, and cash flow, statement of cash flows, and all the attendant ratios that we learned in session 3. We're going to talk about financial planning models. What makes a good financial planning model? What are the key ingredients? 6 key ingredients. We'll talk about that in a moment. Using the percentage of sales approach to forecast the future. That's learning objective number 3. Then we'll look at external financing and growth. How does external financing and investment affect your growth rate within your company? And finally, what are some caveats about financial planning models that we want to be careful of? We will develop a plan. It may take the form of a book or a package or a series of slides, but it's not the plan that's important, it's the planning. Financial planning looks at the way we the way we will attain our financial goals in the future. That may be the 1-year budget target. That may be a 5-year set of plans. It helps us avoid stumbling into the future backwards. We want to know where we're going, and the financial plan will help us get there. We want to anticipate possible problems before they arise. Your supervisor will often say, "No surprises. Please let me know if anything looks like it may be a monster ready to bite us." And so no surprises, please. And we're looking for guidelines for change and growth. From chapter 1, we remember that the financial manager is worried about 3 things. In this chapter, we're going to add a 4th thing. 4th item, the CFO worries about capital budgeting, which again is property, plant, and equipment. We're going to worry about that in our financial plan. The CFO worries about capital structure. Where am I going to get the money to pay for these new buildings that I might have to build to reach my sales goal? In the capital budgeting decision. The capital structure decision answers that. How much debt will I take on? How much equity will I take on? That's point number 2 on the mind of the CFO. Point number 3, how much net working capital will I need to run my business? This is a liquidity decision. Will I have enough current assets to pay off my current liabilities in a timely fashion? And 4th, we're going to add a 4th dimension in this chapter, and that is, do I pay dividends or not? And this is a board of directors management decision. You do not have to pay dividends. You can plow all your monies back into the company if you wish. Growth itself is not an appropriate goal. Again, the overall goal of financial management is to increase market value per share of existing stock. And we want to look at how do we go about doing that in our financial plan. Some examples of overgrowth, overzealous growth, might be the Italian Oven and Boston Chicken. If you've heard of these companies, you may see a few of them still hanging around in some small towns, but they're not as pervasive as they used to be. They both basically grew too fast, did not calculate their internal growth rate and sustainable growth rate. Maybe they should have. Management lost control, just growing too fast, and that they ran into financial failure. Italian Oven collapsed. And again, you may see one or two of these restaurants around occasionally. Boston Chicken was bought by McDonald's and now called Boston Market, and again, growing too fast. They've scaled back quite a bit. You may see some other examples in recent business history of companies growing too fast. Starbucks had some issues here recently where they would put Starbucks on every corner, it seems, in some big cities, and they found that just doesn't work. So growth may be a desirable consequence of good decision making, but is not an end in and of itself. Again, we want to maximize market value per share of existing stock. Two dimensions of the financial plan. Typically, again, you'll do a 5-year plan. The first year of that is called the short run or the budget. So the short run is 1 year, the budget, and years 2 through 5 are called the planning horizon or the long run. And we focus, the long-range planning focuses on years 2 through 5. We will aggregate several different business units in the large company. For instance, at a company where I worked, a large chemical company, I was financial analyst for the Catalyst division. It was a $60 million division. In sales, they had $6 million in net income, 10% net return on sales. And we would add that together with acetylenics, and we would add that together with performance chemicals. We'd add it together with agricultural chemicals, polymers, and so on. All these small business units, small being relative, some of them were fairly large, into the hundreds of millions of dollars in sales, and add them all together, and you come up with a total chemical division, and then we would add a gases division to that, and the total would be a several billion-dollar chemical company. And each of these business units, analysts would develop a financial plan, and we'd add them all together in the aggregate format. Financial planning answers several questions. What can it accomplish? Looking at interactions. How do these various business units interact? How do people interact? What are the costs of these interactions? What are some of the options? Everyone seems to want the star chemical engineer if you're in a chemical company, and you can't work this person 190 hours a week. They're only there 40 hours, maybe 50 hours, and everyone wants the star. So what is the cost of everyone having the star? Can you share that, and are there options to share that key person across many business units? So the financial plan looks at that. We don't want any surprises. We don't want every business unit planning that superstar for 110% of his or her time. And we want to look at feasibility. We want all this to be feasible and internally consistent. Now, in a financial plan, there are 6 key ingredients, the first of which are the economic assumptions. Typically, they come from, in a large corporation, the treasury group upstairs near the CFO or the CFO's office. This may include things like the interest rate, in the case of a chemical company, the price of oil, the price of gas, and things like that. So general economic assumptions are the GDP growth and how fast we think the economy is going to grow. And then from that, we'll make our other predictions. Second in line, we'll then do a sales forecast. Generally, you go to the marketing department, talk to your marketing leadership, and see what kind of volumes they can sell in the coming year and at what price. So you get some price and volume decisions made by the marketing people. At that point, they have to understand they commit to those, especially for the first year. Years 2 through 5 are a little less regulated, but certainly for year 1, that becomes the budget. And their performance may hinge on their ability to make that sales forecast. So they better be careful with what they put into the financial plan, certainly, if they're held to that for performance bases. Pro forma statements are next. So from the sales forecast, we'll do an income statement first, and then the balance sheet, and then the statement of cash flows. All 3 of those key financial statements that we discussed in session 2 will be built. And again, for 5 years, and some of these are this long. They are not just sales and cost and net income, but rather you may see a 30-line income statement with 30 different categories which you'll have to forecast for each and every year, and each of them has a different assumption. That's how it works in the real world. Asset requirements, what kind of property, plant, and equipment do we need to buy and build if we need to hit this sales forecast? And what are the financial requirements in the capital structure? What kind of debt and equity will I take on to grow as fast as we want to grow? Finally, when the balance sheet doesn't balance, we want to plug it in and make the balance sheet balance because it's got to be. as we learned from my former accounting teacher. Plug it in. This is external financing needed when the balance sheet doesn't balance, when assets are greater than liabilities plus equity, and we know it's got to be, so we just simply plug in the difference. And we'll look at where do you plug it in.